All right, what's happening, everybody? Peter Linto back with you. What do we got now? Individual foreign transactions for my friends studying outside of the U.S. For our purposes here, a foreign transaction, the U.S. currency is going to be the domestic. Anything non-U.S. will be the foreign currency, okay? So it's from the perspective of a U.S. company. So let's take a look at what we got. Foreign currency transactions, you might have to record a gain or a loss on those transactions. Why is that? Let's say you have an import purchase that is denominated in a foreign currency. So if you import goods abroad, you'll have an account payable. You're buying from this foreign company, you have an account payable denominated in that foreign currency. You're going to see in a second, well, if that foreign currency goes up in value, that's bad news. Your accounts payable goes up in value. That'll be a loss. On the flip side, sometimes we sell to a foreign company. Therefore, we have an account receivable. When you have an export sale, you might have an account receivable denominated in a foreign currency. Now, if that foreign currency goes up in value, that would be good news. That would be a gain because that would make your receivable go up in value. So that's kind of the context of what we'll be talking about. So anytime you have a U.S. company that agrees to pay or accept payment in a foreign currency, that's a foreign currency transaction. And if between the transaction date and the balance sheet date, or the transaction date and the settlement date, the exchange rate changes, we could have a foreign currency gain or loss. Not that big of a deal, as you will see. All right, so foreign currency terminology, again, unless you're told specifically otherwise, the U.S. dollar, that's going to be our domestic currency. So the exchange rate, the rate at which two currencies will be exchanged at equal value. There's two ways of doing it, the direct or indirect method. No big deal. One's just the reciprocal of the other. But you need to know what's the direct method. Anytime the domestic currency is in the numerator. So if the domestic currency is in the numerator, they're quoting the exchange rate using the direct method. So let's say we have $1.47 in the numerator and €1 in the denominator. So there's two ways of looking at that. $1.47 US buys €1, or the flip side, €1 buys $1.47. Okay, but if that domestic currency is in the numerator, that's called the direct method. If you take the reciprocal of that fraction, you would get 0.68 euro. 1 divided by $1.47 is 0.68. If you have the foreign currency in the numerator, well, then that's the indirect method. So 0.68 euro and $1 is in the denominator. That means 0.68 euro buys $1, or the flip side, $1 buys 0.68 euro. Okay, the current exchange rate, folks, is also going to be known as the spot rate. And you're going to see we need the spot rate on the date of the transaction, the spot rate on the balance sheet date, and then the spot rate, the current exchange rate on the settlement date. Okay. So changes in the exchange rate between the date of the transaction and the settlement date or the balance sheet date could result in a gain or loss. We have to adjust the exchange rate, and then we have to adjust the corresponding receivable or payable, as I'll show you. But I need you guys to commit to memory. Where does this gain or loss go? Well, if we've actually settled the transaction date was in February, we settled it in March. Any gain or loss would be realized, and that's going to go on the income statement. When you actually settle the transaction, then the gain or loss is realized. We'll talk more about that in a second. Now, you've got to commit this to memory, but I want it to make sense. Don't just memorize it. Let's say you have an export sale. So you have an account receivable denominated in a foreign currency. Well, folks, if that receivable is denominated in a foreign currency and the foreign currency goes up, your asset goes up. That's a gain. Conversely, if you have a receivable denominated in a foreign currency that goes down in value, well, then your asset goes down in value. That's bad news, a loss. On the flip side, sometimes you import from a foreign company. You'll have an account payable denominated in a foreign currency. Well, now that's a liability. So if the foreign currency goes up, the liability goes up. That's bad news. That's a loss. Conversely, if you have an account payable denominated in a foreign currency that declines in value, well, that's good news because your liability goes down in value. That would be a gain. Okay. What if the transaction happens, let's say, in November, and it's not settled by December 31st? Well, if it's not settled by the balance sheet date, and the exchange rate changes between the date of the transaction and the balance sheet date, well, then we're going to have to record a change in that receivable or payable, the value of that accounts payable or account receivable, and a corresponding gain or loss. But since we haven't settled the transaction yet, that's going to be an unrecognized gain or loss. But either way, when you have foreign currency transactions, whether it's realized, you've settled it, or it's just the balance sheet date and you haven't settled it yet, either way, unrealized or realized gains and losses, where are they going? On the income statement. Okay, so initially, on the transaction date, the transaction's got to be converted from whatever you have a receivable or payable denominated in a foreign currency. Well, a U.S. company on their books cannot have a receivable or payable measured in a foreign currency. So they simply have to exchange the foreign currency to the U.S. dollar. Since the receivable or payable is denominated in the foreign currency, the way I like to do it, I want to know what one of the foreign currency is buying. This way I can multiply that receivable or payable in the foreign currency times the exchange rate with the foreign currency in the denominator. Okay, I want to know what one of the foreign currency is buying. I want that in the denominator, and then I can convert it to US dollars, okay, just by multiplying. So the transaction is initially recorded using the exchange rate in effect on the date of transaction, okay? So that exchange rate on the date of transaction is going to be the historical rate. We'll then adjust to the balance sheet date if it's not settled by the balance sheet date, and then we'll adjust again once we get to the settlement date. So we got an excellent example here. December 1, year 1 is our date of transaction. Okay, we have an Olinto company. Now that's got to be that's a company you want to take a long position in. You want to buy their call options. Olinto company purchased on credit. So look, you're buying on credit. That's an account payable. And notice it's denominated in the peso. So I want to know what one peso is buying. I want the U.S. currency, the domestic currency in the numerator. I want 1 peso in the denominator, okay? So that's going to be the direct quote. So they tell me on the date of the transaction, December 1st, 1 peso is buying 10 cents U.S. All right, so then all I have to do is take the 100,000 peso, multiply it by the 10 cents, and then I convert that payable denominated in the foreign currency to the U.S., the domestic. So on the date of transaction, we either debit inventory or purchases, whatever the case may be, and we debit it for 10,000 US dollars, okay? We owe 100,000 pesos, but converting that to the US dollar, that's 10,000 US dollars. We credit our accounts payable $10,000, okay? So again, we need to know what 1 peso is buying on December 1st. Put that in the denominator. It's buying 10 cents US. All right, now obviously the transaction is not going to be settled on December 1st. It's going to take a while. It's not even going to be settled by the balance sheet date. So folks, the second thing we have to do is adjust that liability for the change in the exchange rate as of the balance sheet date. So the spot rate on December 31st, well, now the peso is only buying 8 cents US. Is that good news or bad news? Well, the peso's buying less US dollars. The peso's down in value. Well, that means our liability is down in value. That's going to be a gain. We'll see that in a second. It's an unrealized gain, but it goes on the income statement nonetheless. We'll eventually get around to settling the transaction on what date? February 1st of year 2. What happened between December 31st and February 1st? Well, unfortunately, the peso went up by a penny, and it's buying 9 cents US. So we'll adjust again for the change in the exchange rate. Peso up, liability up, unfortunately. That will be a loss, but that loss will be realized because we're actually settling the transaction. Okay, so December 1st, transaction date, debit our purchases or inventory, credit accounts payable, convert the 100,000 peso to 10,000 US. Now it's the balance sheet date. 1 peso is now only buying 8 cents US. So what's the change in the exchange rate? 2 cents. So we take the 100,000 pesos, that payable denominated in the foreign currency, we multiply it by the change in the exchange rate, 2 cents. I'm going to debit my accounts payable. Why? The payable's going down in value. This is good news. The peso's down in value, so my liability is down in value. So I debit my accounts payable. Now the payable's on my books, not at 100,000 pesos, but at 8,000 US dollars, okay? So the payable's down by 2,000, and that's a foreign currency transaction or foreign exchange transaction gain. That gain makes net income go up, which makes retained earnings go up, which makes equity go up. So no change to assets, liabilities down, equity up. Okay, so that's the balance sheet date, and that gain would be unrealized. We finally settled the transaction on February 1st of year 2. On that date, the spot rate, 1 peso is now buying 9 cents US. So unfortunately, the peso went back up by a penny. So the liability is going up. There's going to be a realized loss now. Okay, so the first thing we have to do is get the payable off our books. As of the balance sheet date, the last time we adjusted the payable, it went from 10,000 US down to 8,000 US. How do we remove a liability? We debit the liability. Now we've got a loss. What kind of a loss? Well, the peso went up by 1 penny. We take the 100,000 pesos, multiply it by the change in the exchange rate, 0.01, and we know that's a loss because the payable went up in value. So we're going to debit the loss, but that's a realized loss of $1,000. Now we credit cash. What do we have to write a check for? What is the spot rate on the settlement date? Well, 1 peso is buying 9 US. So 100,000 pesos times the 9 cents US, we actually cut a check for $9,000. Our balance sheet is in balance. Liability comes off the books, 8,000. Liability down by 8,000. Since we recorded a loss, net income down, retained earnings down, equity down by $1,000. So the liabilities and equity are down by a total of 9,000. And then our balance sheet is in balance because by crediting cash, assets go down by how much? 9,000. So nothing to memorize, reason your way through it. A receivable denominated in a foreign currency, I like when the foreign currency goes up because then my asset goes up. If the foreign currency goes down, my asset goes down, that would be a loss. With a liability, if the foreign currency goes up in value, liability's up in value, bad news, loss. If the foreign currency goes down in value, your accounts payable goes down in value, good news, that's a gain. Transaction date, balance sheet date, to the settlement date, okay? And just reason your way through it and you'll be in great shape. So I know you're excited to practice that. You might as well bang it out right now, all right? So good luck studying. I'll see you in the next topic.